Hey everybody, it's Seth and Paul for the Everything Money Channel. On this episode, we talk about AT&T stock, whether you use them as your phone carrier or Verizon. My mother's worked there for 50 years. I've had this stock. It's stagnant. It has a high dividend. What do all this mean? What does all this mean, and what does it mean to you as a potential stock buyer? Learn about AT&T stock right now as we go over the 8 pillars with Paul right now on the Everything Money Channel. Let's go. Hey everybody, it's Seth and Paul for Everything Money Channel. My mother worked for Ohio Bell, Southern Bell, Ameritech, AT&T. She started in the 60s, Paul. This is one of her first jobs. She literally had to, I didn't know this, she had to unplug the plugs like in Mad Men. Like, let me connect you and unplug a guitar cable and put it elsewhere. And I didn't realize this, Paul. You didn't know this either, Don. Because I guess back in the day, like homes would share phone lines. So you would connect. What do you mean? Listen to me. If you wanted to call... If you called someone, you would connect a line and you would go to different homes and you could hear other people talk at the beginning of your conversation and then you had to figure out if it was for you or not. I'm telling you, this is what my mother told me. We'll have to look into it. But regardless, you're not here for this bullshit. You were here for AT&T. I bring up AT&T. One of our last videos was about dividend. AT&T has a 6.5% dividend, one of the largest ones out there, I think, right, Paul?
Yeah,
one of the biggest
probably.
ones. However, their stock has been stagnant for a long time. I was a long-time owner because, again, going back, I bought stocks that I liked. I like AT&T over Verizon. Tell me about the health of this company, the stock, and whether you're a buyer or a seller.
Okay, so your mother worked for AT&T. That's why it's relevant. The reason I like talking about AT&T is they're such a big company.
Huge, right?
And over the decades, their stock, this is going back to 1984, their stock in 1984 was selling for $5 a share. And now it's at 30. And you think to yourself, that's a lot. It's 6 times growth. No, the stock market alone's up 30 times almost since 1984. Probably 20 sometimes. So it hasn't done as well as the market. This is a boring company, right? I
Yes.
mean, what's really exciting about AT&T?
I hear they're worse than Verizon.
Nobody's as bad as Sprint, though.
Right.
But we have our 8 pillars. We have our 8 pillars of things to look at in a stock. So we're going to go through these 8 pillars and see how they do. What's the first one, Uncle Seth?
The first pillar is revenue growth over the last 5 years.
Okay, so 5 years ago, $146 billion, $164 billion,
I like this.
$160 billion, $170, $181.
Looks like good revenue growth.
Okay, they have revenue growth.
Not massive, but okay.
Not massive, but pretty good.
Okay.
And a company this big, you're not going to expect more than mid-single digit growth every year. Now, this could also be because they bought companies along the way. We won't get into that right now, but that is one of the metrics that as we do our 8 pillars, the next stage would be, okay, how do they get the revenue growth? But right now, for all intents and purposes, they have revenue growth. So green check mark to revenue
Number
growth.
1, cha-ching.
Cha-ching, cha-ching.
Pillar number 2, profit.
Pillar number 2.
Profit growth over the last 5 years.
They love making money. $13.5 billion, $13 billion, $29 billion, $19 billion, $14 billion. Okay.
Well, yeah.
It's kind of, but they've still made a lot of money. For a company like AT&T, it's going to be difficult for them to make a lot of money every single year. They're everywhere. Does this bother me? No. Technically, is it up? Yes. Now look at the previous 5 years. They did 24, 7, 18, 6. So they have more profit in the last 5 years than the previous 5 years. I'm kind of in between on this one. Can we do like an equal sign? Like I'm indifferent on this one. Like I'm not going to give it a green check mark. I'm not going to give it a red X. This is the first time we've ever like even said that. But I don't know if this isn't a good thing. It's not a bad thing. It just is.
Okay, what about the pillar number 3, free cash flow?
Okay, so remember what free cash flow is, everybody. You know what's the great part is? If you watch all my videos, by the end of this, you're going to know what free cash flow is like that. You go to the free cash flow, you go to the cash flow statement. You take your cash from operations, and you subtract out your capital expenditures. Now, you're not subtracting negative. The bottom line is, so free cash flow growth. 35 minus 19, 16 billion. 38 minus 21, 17 billion. 38 minus 20, 18 billion. 43 minus 20, 23 billion. 49 minus 19, 30 billion.
Looks good. Look at that look on your face, Paul.
I love it.
That was your O face.
That's really good.
Nice.
So I look at this as a better metric than the income statement. This puts me at a massive green check mark. A company this big that can increase their free cash flow that consistently and almost double in 5 years, I love it. That to me is phenomenal. Green check mark. Definite green check mark.
Or a blue thumbs up. Please like the video right now. For Paul and I's sake, dear God, he needs all the likes he can get. Please like the video and please.
Talking about
I'm begging these
insecurities
people.
back in my day.
I'm begging these people.
Not getting the likes from the ladies.
But really, it takes 2 seconds. We're doing all this for you. Paul is giving all of this knowledge and repay him with a simple click
I
of that
make my
thumbs up.
investing decisions the same way I'm talking to you guys about it. I'm releasing all my quote unquote secrets. I don't do anything because at the end of the day, I could be wrong.
Keep going.
Okay.
Pillar number 4.
Pillar number 4. What's pillar number 4?
Well, this
Seth?
is my favorite. This is a PE ratio, price to earnings ratio.
Okay, we want it to be under 20. So if you remember, PE ratio is your price of your stock minus the earnings per share, or the total market cap of the stock divided by the total earnings, net income. And we're at 19. So it's less than 20. Now, it is a big company, so it should probably sell for less because it has less growth potential.
Okay.
But 19 isn't terrible. With a 6% dividend, 7%, almost 7% dividend yield, okay, free cash flow is increasing. It's still a green check mark. Usually I like to pay a lower PE ratio for bigger companies because there's less growth potential. But 19 isn't terrible.
Okay.
All right, next one.
Pillar number 5 is the total current assets greater than the total current liabilities.
Okay, so we go to our balance sheet for that. Total current assets, for everybody to remember, is the
Cash in my bank
hand.
account.
Cash on hand. Let's just call it cash on hand or things that can be converted to that very quickly.
Okay.
Cash on hand currently, $55 billion. That's a lot.
Okay.
$55 billion, okay? What's their current liabilities? The money they owe right now. For everybody out there, it's like if you had your current assets are the money in your bank account, your current liabilities are the bills that you owe right now.
Utilities, car payment.
Correct.
Tuition.
Total current liabilities. Oh boy.
Uh-oh.
Oh boy.
70 billion?
70 billion.
They're in the red?
So they owe more money. Now, it doesn't mean this is a bad thing. But one of the things you have to, it still gets a red X. But I'm giving the caveat of every business is different. Restaurants tend to have less current assets than current liabilities. You got to understand why that is. I don't know why that is, but this is definitely a red X for me. I don't like the fact. Now, let's go see if that's pretty consistent over time. So, last year, 51 billion in current assets, 64 billion in current liabilities. Let's go back randomly 10 years ago. 20 billion in current assets versus 35 billion in current liabilities. So it just seems like AT&T is that company. They just tend to have, it's still a red X, but it's not as bad. It's not like they've gone from always having more money than they need to all of a sudden being in the negative. So there's probably something having to do with the way they bill out and the way their receivables come in and payables, et cetera, that make it a problem. We have to understand that.
So not a damaging red X, but you're not in love with this.
Correct. It's not terrible. It's not great.
Pillar number 6 is the price to free cash flow less than 15.
Okay. So if you remember, price to free cash flow is the market cap, 217 billion, divided by last year's free cash flow. What was last year's free cash flow, Seth? Do you remember? You probably don't.
It's a 50 billion, 54 billion?
No.
It
was about 30 billion.
Okay.
So they have 217 billion in value divided by 30. 7 is their price to free cash flow. We want it to be less than 15.
That's really good.
That's really good.
We haven't seen one of these in a while.
If you were to buy this company and it kept this, every year you get a 7 to 1, you get a 14.5% return on your money. Because think about it. Every year you invest, you buy 217 billion, buy it for 217, you're getting 30 billion after taxes and everything. And investing back in your business. So after 7 years, you got your money back. That's really, really, really good.
Oh.
Yes. So it makes me worry less about this PE ratio. It makes me worry a lot less. Now, one of the things you have to do is go see if that's consistent over time. And we saw before that their free cash flow was consistent and growing. So this is a really good thing.
Pillar number 7 is profit margin greater than 10%.
Okay, so the profit margin. Wah, wah, wah.
What, Paul? What's wrong? What is it?
3%.
Uh-oh.
Now that's quarterly. Wait a second. I want to go back and see what the year was. So let's go back to the year. So we're going to go back to, we're going to do the financial statements. And profit margin is net income divided by revenue. So the net income was 14 billion and the revenue was 180 billion. So what is that? 8%, 7%? So it's still less than 10%. The last quarter was worse. It could be for whatever fluke reason, but it's not as good. All right. So is that a red flag? I have to understand AT&T's business better. Maybe they have a reason why their margin's so low. I don't know. It's not the worst thing in the world. It's not the best thing in the world. But it's still like, okay, I prefer the one. There's a lot of businesses that have low profit margin. But you got to understand what kind of risks are involved with that.
The final pillar is decreasing share count.
What would you guess? Do they decrease or increase their share count? And why?
This one's tough because the price of the stock has been stagnant for a while. They're not rapidly growing, and they give a high dividend. I don't know, Paul. Sometimes I get confused. That's why we're doing these videos. I'm going to say they have decreasing share count, and here's why. Because they're stagnant, they want to give their shareholders some other. They have a lot of free cash flow and they're stagnant. So what they're going to do is say, let us buy back shares. That way our shareholder who owns a share, it now gets bigger pieces of our revenue and profit. So I'm going to guess that it's actually decreasing. 10 years ago, I was wrong. 5.9 billion, and now they're at 7.3 billion. Pretty significant.
Yeah, I don't like that.
No.
I do not like that one. I do not like that at all. And it's pretty consistently. I don't like that way. For a while there, actually, they were decreasing, and then they went back up. So one of the things to do after this analysis is go through and understand. This is why I'm talking about. These 8 pillars are just the foundation. My personal opinion is I'm not a no on AT&T yet. I'm not a definite buy. I have to go understand a few things. One of which is, why are they increasing their shares? There could be a very valid reason, but for a slow-growing company, I don't get what it would be. I have no idea. What was the other question I had? Oh, their profit margin. Why is their profit margin so low? Because service businesses, which is a lot of what they do, tend to have high profit margin. Remember, Microsoft was almost 30%.
Yeah, I would think the same thing. I mean, it's not like they're not producing computers. They just have a couple people in their stores.
Nobody makes phones anymore.
Yeah, I'm trying to think. You're right. It's just like, that's funny.
But either way. So here we had a few red X's. Not terrible. Not awful. I'm not a no on AT&T, but I got to understand, I definitely love their dividend is very secure, it seems, but I got to understand what are they doing that is making their share, because to me, the shares increasing is not looking after the investor, unless there's a real valid reason, like they're making good acquisitions with those shares. They're not looking after us as an investor. That means if you owned a share in 2010, you now get 15%, 20% less 20% less of the profit in the company than you did for that same share before. So the profit goes up 20%, you're even essentially, because you've been diluted. It's not really good for the shareholders, if you ask me.
Follow the Everything Money channel. Like and subscribe below. There's plenty of videos that Paul analyzes. Tons of. We've got great traction with our Boeing video, doing Boeing stock, Tesla stock, Amazon. Go back in time and watch some of those videos, and we'll always be updating the stocks, the ones that hit hot and the ones that don't.
And a year from now, AT&T will look totally different because the price will have changed. That's the great thing about that's the great thing about our videos. Make sure you look at the dates of these videos because they pertain to the time that we are sitting in. It'll change as the price goes up and down.
Thank you, Paul. Thank you for your insight. Everything Money channel. Like and subscribe. Thanks, guys.